put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The man who could see tomorrow. In the shadowy corridors of American finance, where billions move in whispers and fortunes rise on secrets, there exists a truth most will never speak aloud. Money doesn't just talk, it conspires. And in the autumn of 2009, the FBI was listening. They called it the largest insider trading ring in history, a network so vast, so meticulously constructed, that it operated like a shadow government of wealth, invisible, untouchable, omniscient. At its center sat a man who had mastered the art of knowing what others didn't, a billionaire hedge fund titan, whose empire was built not on genius, but on a currency far more valuable than money: information that wasn't his to possess. His name was Raj Rajaratnam, and the day federal agents knocked on his Manhattan penthouse door at dawn, they weren't just arresting a man. They were dismantling a machine that had been extracting wealth from the darkness for over a decade. This is the story of how one man turned corporate America into his personal casino, and how the house always wins until it doesn't. Raj Rajaratnam arrived in America with the hunger that only immigrants truly understand. Born in Colombo, Sri Lanka, in 1957, he came from wealth, but not the kind that buys empires. His father was the head of a South Asian Pepsi bottling operation, comfortable, respectable, but far from the gleaming towers of Manhattan, where real fortunes were forged. He studied engineering at the University of Sussex, then pivoted to business at Wharton, that incubator of American corporate ambition. By 1985, he had landed at Chase Manhattan Bank, analyzing tech companies in Silicon Valley, when most of Wall Street still considered technology a sideshow. But Rajaratnam saw what others couldn't, or wouldn't. The future wasn't in steel or oil. It was in microchips and software, in the digital revolution that was about to remake civilization itself. And whoever understood those companies first would become unimaginably wealthy. In 1997, Rajaratnam founded Galleon Group, a hedge fund focused exclusively on technology stocks. The timing was impeccable. The dot-com boom was beginning, and money was flooding into anything with .com in its name. But Rajaratnam wasn't riding hype. He was building something far more sophisticated, an information network. On the surface, Galleon looked like any other successful hedge fund: brilliant analysts, cutting-edge research, returns that made investors salivate. At its peak, Galleon managed $7 billion in assets. Rajaratnam himself was worth $1.8 billion, living in a $3.5 million Manhattan penthouse, flying private, moving through the upper echelons of American capitalism like he'd always belonged there. But beneath the veneer of legitimate success, another business was operating. A dark business, one that didn't rely on analysis or insight, but on something far simpler and infinitely more valuable: knowing the future before it happened. The stock market, for all its complexity, operates on a fundamental principle: uncertainty. Will a company's earnings beat expectations? Will a merger go through? Will a product launch succeed? These unknowns create risk, and risk creates opportunity, but only for those playing by the rules, making educated guesses based on public information. Rajaratnam discovered something that would transform his fortune. What if you didn't have to guess? What if, instead of analyzing quarterly reports and market trends like everyone else, you simply knew before the press release, before the announcement, before the market could react? He began cultivating a network, not of analysts, but of insiders, corporate executives, board members, consultants, people who sat in conference rooms where the future was decided behind closed doors. The method was elegant in its simplicity. Rajaratnam would befriend these individuals, often fellow South Asians who shared cultural ties, common backgrounds, the implicit trust of shared heritage. He'd wine them, dine them, make them feel like part of something exclusive. And then, almost casually, he'd ask questions. How's the quarter looking? Any big announcements coming? What did the board decide yesterday? Sometimes he paid directly, six-figure consulting fees for information worth millions. Sometimes it was subtler, stock tips flowing both directions, a gentleman's agreement among the financial elite. And sometimes it was simply the intoxication of being close to power, of being the person a billionaire called for advice. One of his most valuable sources was Anil Kumar, a senior director at McKinsey & Company, the prestigious consulting firm that advised the world's largest corporations. Kumar had access to confidential business strategies, merger plans, earnings forecasts, the crown jewels of corporate intelligence. For years, Kumar fed Rajaratnam secrets. In return, Rajaratnam paid him over $2.5 million, routed through offshore accounts to hide the transactions from tax authorities and compliance officers. Then there was Rajat Gupta, perhaps the most shocking conspirator of all. Gupta wasn't some mid-level executive hungry for extra cash. He was the former managing director of McKinsey, a board member of Goldman Sachs and Procter & Gamble, an advisor to the United Nations. He moved in circles with presidents and prime ministers. Yet even Gupta couldn't resist the gravitational pull of Rajaratnam's operation. From his position on Goldman's board, Gupta had access to information that could move markets. Warren Buffett's $5 billion investment in Goldman during the 2008 financial crisis, the firm's quarterly earnings, strategic decisions made at the highest levels of global finance. Gupta would attend confidential board meetings, then step outside and call Rajaratnam. Minutes later, sometimes seconds, Galleon would execute massive trades, positioned perfectly to profit from information the rest of the market wouldn't see until the following day. But here's what made Rajaratnam's network truly terrifying: its scale. This wasn't one rogue trader making illegal bets. This was a systematic operation involving dozens of conspirators across multiple companies, industries, and continents, former employees of Intel, IBM, Google, Hilton, and countless others, executives who violated their fiduciary duties not once, but repeatedly, turning corporate confidentiality into a farce. The conspiracy generated estimated illegal profits exceeding $60 million, though investigators suspected the real figure was far higher, buried in complexity and offshore accounts. And for years, it worked flawlessly. Rajaratnam's returns were legendary. While other hedge funds struggled during market downturns, Galleon seemed almost prescient, zigging when others zagged, always positioned on the right side of major corporate events. Investors flooded in, believing they'd found a genius who could see around corners. They had no idea they were funding a criminal enterprise masquerading as brilliance. But in the shadows where Rajaratnam operated, someone else was watching. The FB. I had been investigating insider trading on Wall Street for years, but the street was slippery, protected by lawyers, complexity, and the unspoken code that everyone skirts the rules a little. Proving insider trading required something almost impossible: evidence that someone received non-public information and traded on it knowingly. Then, in 2007, something changed. Rumi Khan, a former Intel executive and one of Rajaratnam's sources, got caught in her own insider trading scheme. Facing prosecution, she made a choice that would detonate Rajaratnam's entire empire. She cooperated. Khan told investigators about Rajaratnam's network, about the payments and the secrets and the systematic corruption. More importantly, she agreed to wear a wire. But Khan alone wasn't enough. The FBI needed more. They needed to hear Rajaratnam himself, in his own words, discussing the conspiracy. In March 2008, federal prosecutors took an unprecedented step. They obtained a wiretap warrant for Rajaratnam's cell phone. This was the first time in history that a wiretap, a tool typically reserved for mobsters and drug cartels, had been approved for a Wall Street investigation. For months, the FBI listened. They heard Rajaratnam casually discussing confidential earnings reports before they were public. They heard him coordinating trades based on insider tips from corporate executives. They heard him coaching conspirators on how to hide their tracks, how to make illegal trades look legitimate, how to cover up the money trail. In one particularly damning call, Rajaratnam discussed Goldman Sachs's quarterly earnings, information he could only have obtained from someone on the inside, someone like Rajat Gupta. Minutes after that call, Galleon executed trades worth millions, positioned perfectly to profit from the confidential data. The wiretaps captured over 2,400 conversations, and with each recording, the FBI's case grew stronger, the net tightening around a man who had believed himself untouchable. But Rajaratnam had no idea. Even as the evidence mounted, even as the FBI built their case brick by brick, he continued operating with the confidence of someone who had never faced consequences. He attended charity galas, gave to elite universities, sat on non-profit boards, the portrait of a successful immigrant who had achieved the American dream. Then, on October 16, 2009, at 6:30 in the morning, federal agents arrived at his Manhattan apartment. The man who had spent a decade collecting secrets was about to learn that someone had been collecting his. The arrest sent shockwaves through Wall Street. Rajaratnam, the billionaire hedge fund manager, was led from his penthouse in handcuffs, charged with conspiracy and securities fraud. Simultaneously, 5 others were arrested. Just the beginning of what would become the largest insider trading prosecution in U.S. history. The indictment was devastating. 14 counts of securities fraud and conspiracy. Evidence including those thousands of wiretapped calls, financial records tracing illegal payments, testimony from cooperating witnesses who had already flipped. Rajaratnam's lawyers mounted an aggressive defense. They argued the wiretaps were illegal, an unconstitutional invasion of privacy. They claimed Rajaratnam was simply an excellent investor, that his trades were based on sophisticated analysis, not illegal tips. They painted him as a victim of overzealous prosecutors, targeting a successful minority businessman. But the evidence was overwhelming. At trial, prosecutors played the wiretaps. Jurors heard Rajaratnam's voice, casual and confident, discussing information that could only have come from corporate insiders. They heard him congratulate sources on providing valuable tips. They heard him explain to junior traders how to structure trades to avoid detection. The defense tried to argue that Rajaratnam was engaging in mosaic theory, the legal practice of piecing together public information to form investment insights. But the prosecution showed otherwise. They demonstrated trades executed within minutes of confidential board meetings, positions taken right before major announcements that no amount of public analysis could have predicted, profits that defied statistical probability without inside information. One particularly damning example. On September 23, 2008, at 3:58 p.m., Rajat Gupta attended a Goldman Sachs board meeting where Warren Buffett's $5 billion investment was approved, a deal that would send Goldman's stock soaring. At 4 p.m., just 2 minutes after the meeting ended, Gupta called Rajaratnam. They spoke for 90 seconds. Within a minute of hanging up, Rajaratnam began buying Goldman stock, $40 million worth in the final minutes before the market closed. The next morning, Goldman announced the Buffett deal publicly, and the stock jumped. Rajaratnam sold, pocketing millions in overnight profit. The jury didn't need to speculate. The timeline told the story. On May 11, 2011, after 12 days of deliberation, they returned their verdict. Guilty on all 14 counts. The courtroom was silent as the verdict was read. Rajaratnam showed no emotion, but the color had drained from his face. Behind him, his family wept. 6 months later, at sentencing, he stood before Judge Richard Holwell and made a final plea for mercy. His lawyers argued that his diabetes and other health issues meant prison would be particularly harsh. They pointed to his philanthropy, his charitable giving, the hospitals and schools that bore his name in Sri Lanka. Judge Holwell was unmoved. Insider trading is an assault on the free markets, he declared from the bench. It puts the average investor at an inherent disadvantage and undermines the integrity of our financial system. He sentenced Rajaratnam to 11 years in federal prison, the longest sentence ever handed down for insider trading at that time. Rajaratnam was also ordered to forfeit $53.8 million and pay a civil penalty of $92.8 million. Galleon Group, his $7 billion empire, shut down permanently. But the reckoning didn't end with Rajaratnam. The investigation he triggered became a dragnet that pulled down some of the most powerful figures in American business. Rajat Gupta, the former McKinsey chief and Goldman Sachs board member, was convicted of insider trading in 2012 and sentenced to 2 years in prison. A stunning fall from grace for a man who had advised prime ministers and sat on the boards of elite institutions. Anil Kumar, the McKinsey director, pleaded guilty and received a lighter sentence in exchange for cooperation, but his career and reputation were destroyed. In total, the investigation led to more than 60 convictions, dismantling what prosecutors called a corrupt network that operated for years in plain sight, protected by wealth and connections. Rajaratnam served 7.5 years in federal prison before being released in 2019 for good behavior and health reasons. He returned to a world that had moved on without him. His fortune, once estimated at $1.8 billion, had been decimated by legal fees, fines, and forfeiture. His reputation, carefully cultivated over decades, was reduced to a single word: criminal. He lives quietly now, largely out of the public eye, residing in a modest home in New York, a far cry from the penthouse and private jets of his former life. But the story of Rajaratnam isn't just about one man's greed. It's about the dark machinery that powers parts of modern finance, the unspoken understanding that information is the ultimate currency, and that some people will always be willing to pay any price to obtain it. It's about the psychology of entitlement that comes with extreme wealth, the belief that rules are for ordinary people, that being smart means being above the law. Rajaratnam had everything: brilliance, opportunity, connections, legitimate talent that could have made him wealthy without breaking a single law. But he wanted more. Not just success, dominance. Not just wealth, certainty. And so he built an empire on secrets that weren't his to possess. The deeper lesson is how systems fail when powerful people decide they're exempt from them. Rajaratnam's network included some of the most respected names in business: McKinsey directors, Goldman Sachs board members, executives from America's most prestigious corporations. These weren't desperate people. They were already wealthy, already successful. But proximity to greater wealth to someone like Rajaratnam, who seemed to defy gravity, created a moral compromise. A phone call here, a tip there, money flowing to offshore accounts where nobody would look. Until someone did. The wiretaps changed everything. Before Rajaratnam, Wall Street operated with a certain arrogance, a belief that white-collar crime was sophisticated enough to stay hidden, that insider trading happened but proving it was nearly impossible. After Rajaratnam, that changed. The FBI demonstrated they would use every tool available, including those historically reserved for organized crime, to pursue financial criminals. The message was clear. No one is above the law, no matter how wealthy, how connected, or how clever they believe themselves to be. Yet the fundamental problem remains. Insider trading still occurs. Markets still reward those with the best information. And in the high-stakes world of finance, where millions can be made or lost in seconds, the temptation to cheat, to know what others don't, will always exist. Rajaratnam's story is a warning, but it's also a mirror. It shows us what happens when ambition disconnects from ethics, when the pursuit of wealth becomes an end that justifies any means, when brilliant people convince themselves that being smarter than the system means they've earned the right to exploit it. And it reminds us of something darker still. For every Rajaratnam who gets caught, how many others are still out there, operating in the shadows, believing they're too smart to ever face consequences? That's the real chill that should run down your spine. Not that this happened once, but that somewhere, right now, someone else is picking up the phone, about to share a secret they shouldn't know, about to execute a trade they shouldn't make, about to join a network that operates in the darkness where wealth and power believe themselves untouchable. Until, one day, someone starts listening, and the line goes dead. Subscribe and listen to our next story below.